So with all this news at our fingertips, there's still one question that the board behind me can't even answer. Where does the market go from here as we enter into the end of summer? Well, I'm going to show you where I think it's going and how I'm going to play it. Let's get going. Hey everybody, Tom Gentile. I want to welcome you to Tom's Trading Room, and it is the middle of August. I want to discuss stocks, bonds, currencies, commodities. Also, I want to get into holiday trading patterns because this is the time to be talking about Labor Day, not the week of Labor Day. You'll see what I mean. Hey, if you like this video, then show us some love and give us a thumbs up there, down there at the bottom of the screen. If you subscribe to our videos, you'll get them as soon as they come out. Liking our videos actually helps support this channel. All right, so let's get right to it. As I slide over and take a look at the stock market, you're looking at a chart of the SPY right now. This is the S&P 500 ETF. Starting in mid-April, we were down around 275 and made some very nice steps where we stair-stepped up to resistance. All right, this resistance point at just below 325 that occurred around the first week of June. We had a pullback to what we call support. All right, we've had some support levels right here around 300. This was a really good area of support, and we bounced off that 3 times. Right, and now since then we've gone through the resistance of around 323 and are now sitting very, very close to all-time highs for the S&P 500. The bond market has also climbed up, but it's ran into a roadblock here at 172, the old resistance back around April 17th, right? So, but I wouldn't worry about this as a stock trader if I were you, right? If we see a huge sell-off in bonds, that could mean interest rates are going to be on the rise. But I see this as just a necessary pullback as traders are getting out of bonds and getting into stocks. What say you, U.S. dollar? Well, let's take a look. The U.S. dollar, which was trading in this case, I'm looking at UUP. This is the Power Shares Double Dollar, which was trading around 27.20, and it had that on its eyes as resistance, pulled down to support at 26. And around the 26 area, we hit support twice before breaking through, and now new support is, guess where? 25. One thing watching the U.S. dollar drop is, like I said before, that's good for stocks, good for foreign currencies, and it's good for commodities like my next commodity, which is USO. USO, the ETF for crude oil, down here where the S is, all right, that was a reverse stock split that occurred at the end of April. At that time, after the reverse split, USO was trading just north of 17, all right? Since May, since the end of April, early May, we have come up and are now trading above 30. That is a near double in the price of USO and in the price of oil just in the last few months. Now, what's good for oil is good for oil stocks, and what's good for oil stocks is also good for the U.S. stock market. But the big question remains, where do we go from here? Well, technically, we look good. The stock market's going higher. The trends look good. All of the fundamental corporate information for Q2 is now out of the way, all right? Earnings are now, for the most part, gone. And we're now in an area that I like to call no news August. No news August means that no news is typically good news on the street. And as we head into Labor Day, there's one more pattern that I want to show you, and that is the seasonal pattern. There are 8 major holiday patterns that I follow. They are New Year's Day, Martin Luther King Day, President's Day, Good Friday, Independence Day, Labor Day, Thanksgiving, and Christmas Day. Those 8 patterns or 8 holidays have patterns that trade around them. And for the most part, when you chunk them all together, they do better than average in terms of buying versus selling around these holidays. Let me tell you what I'm talking about. So if we take a look at, for instance, the holiday pattern coming up now, which is Labor Day. Your typical idea is to buy 2 days before and sell 1 day after each holiday. So according to Stock Trader's Almanac, The pattern during Labor Day averaged 80% between 1950 and 1977. But between 1977 and, say, the year 2010, it has dropped down to where the win-loss ratio is somewhere in the mid-50s. But how is it done since then? And more importantly, what if we could dynamically look at this information to find the best actual day to buy and the best actual day to sell any stock or ETF, or even option for that matter? Well, we can, and it's with a tool that's on tomsoptiontools.com, and it's called Money Holidays. Here's how Money Holidays works. I input a particular stock in the stock category. I have a look back of up to 20 years. I'll put the major holiday in that I want to look at. I can look at before, after, or even in between the holiday. I put the number of days before in, the number of days after in that I want to back test. And for this particular example, I ran back the SPY. And the SPY showed me that 20 days before Labor Day, it ran 400 tests, and it found that between 70 and 80% of the time, depending on the days that you bought in on the S&P, it moved higher during the Labor Day pattern. And this is the last 20 years. So we're talking about patterns where if you look at 17 days before Labor Day, we averaged 1% during this pattern, and that was happening 80% of the time. Now I want to take you to a live position so I can show you one that looks even better right now. So to do that, let's slide it back over to Tom's Tools. We're going to go to Money Holidays and take a look at TLT. So I ran the pattern on TLT, and going back 15 years, I found that 19 days before, that's right now, all right, you're talking about 2.69% that this has worked, or $2.37 profit, and that's on average. 93.33% effective over the last 15 years. To dig deeper into this, I'm going to click right here, and I'm going to look at every year back. So the only loser was in 2015, all right, where we lost a little bit more than 1%. Look what happened last year. Last year, this particular pattern averaged 6.5%, and if I click on it, you can see what happened. So we're talking about bonds being down here around 135 and climbed to over 144 during this particular pattern heading up into Labor Day. So this is very exciting. So what we've done so far is we have spotted a pattern. We have back tested that pattern. Now what we want to do is create a low risk trading opportunity with this pattern. And for that, I'm going to use options. So now I'm going to go to the stock and options table. And I want to look at options on TLT. Labor Day falls on September 7th. So we're going to use the 11th as our expiration date. Let me go ahead and update this. And now you're going to see options that are going to expire on September 11th for TLT. Now, if I come down, I got calls on the left and I got puts on the right. We're going to look at call options because this is the easiest way to go right here. So what we're looking at right now is we're looking at options on TLT that expire September 11th. This is the 169.5 calls. Here's the 170 calls. Let's take a look at the 170 calls because it's a round number. Now, right now they're being offered bid at 230 and offered at 249. So 240 is the mid price. Now, I want to go back to my holiday pattern for just a moment because my holiday pattern showed that on average this worked to about 2.69% or $2.37. Now, the problem I see right away is that if I look at the options, these are really near money call options. They're slightly out of the money. I would need TLT to go to 172.40. That's 170 plus 240. That's 172.40 to break even by September 11th. All right? Well, if the pattern says that on average we only go about $2.37, I could actually lose money on this trade. So I have to pick the right strategy that fits within the parameters of the particular system. This particular system called Money Holidays is going to work for me. So a call spread is where we're buying a lower strike call. Let's call it the 170. All right, so I'm going to buy the 170. And I'm going to simultaneously sell, let's sell the 172s. So if I buy the 170s, and I'm going to put a -1 out here for 172s, now I'm going to pay $240, roughly $240 for the 170 calls. But I'm going to bring in maybe $1.62 or something along that line for the September 11th 172 calls. What is this trade going to ultimately cost me? Well, I'm going to come back up here, I'm going to click on risk graph, and now we're going to see a risk graph for this option. So this trade is going to cost me roughly $78, all right? It's 78 cents when you subtract 240 from 162, but you got to multiply that times 100, so that gives you a cost of $78 for the trade. So if my cost is $78, then guess what? My risk, my maximum risk at expiration is also $78. What's my reward? All right, this is a very easy calculation that you can do. You take the difference between strikes, 172 minus 170. That's 2. Back out the 78 cents, and $2 minus 78 cents gives you upside maximum potential of $122 or $122 for this spread. So we have an entry cost and risk of $78. We have a maximum profit of $122. That's a reward to risk ratio of over 150%. Looking at this on a risk graph, it would look like this. So look what's happening with TLT, kind of moving around, slowly moving up, pullback. But if TLT gets up to or above 172 at expiration, you're looking at maximum profit potential. Now it's time to plan it, execute it, and then of course manage it. Now to plan it and execute it, I'm going to go to my broker, one of my broker platforms. This is Street Smart Edge from Charles Schwab. I'm not endorsing any brokers. You can use whoever you want. Just make sure your option broker allows you to go in and create option spreads like this. Now, looking at this call spread, I got TLT. I'm going to put in call spread. Now it's just a matter of adding everything in. So I want to buy the lower, sell the higher. So I want to buy the 170s, and I want to buy the 170s for September 11th. So I'm going to come and find the September 11th expiration. Now it's already populated the stuff at the bottom, but I want to sell the 172s. So I'm going to change this to 172. And immediately what I get is I get the bid and the offer down here. Look, 60 by 96. So it's still right there, right in the middle at 78. If I want this trade at 78 cents, I have to create what's called a limit order. Basically means that I want it at my price or better. You can give it to me for better. I'm fine with that, but no worse than 78 cents. So I'm going to click on 78, and it's going to automatically populate it down here. It's a limit order. It's a debit to me. That means I'm still paying for the spread. Even though it's cheaper than paying for a call, I still have to pay for something. The spread's costing me 78 cents if it gets filled. In this case, all I'm doing now is simply coming over, and I'm going to preview the order. And once I preview the order and I'm happy with it, I then place the order. Hey, I hope you enjoyed the video, and if you did, show us some love and give us a thumbs up below. Also, subscribe to the videos, hit the bell, and you'll be notified every time I upload a new one. Finally, we have reached the 10,000 subscriber mark in just a few months. And to show my appreciation for this, check the links below because I have links on how you can get a 2-week free trial as a new member to Tom's Option Tools. And that is everything, not just a small trial, but an everything trial if you want it. For details, click on the link below. I'll see you next time. Bye now.